welcome our top guest on the show to help us understand how to go about the market mood and the triggers that we are looking at. We have with us Mr. Mayuresh Joshi, Head of Equity Research at William O'Neill, India, joining in. Warm welcome, Mayuresh. Good to have you with us. 5 months of pain. What's next?
Morning, Sakshi. I think so. We continue with our stance. We remain cautious on the market because I think the rhetoric that is still getting played out will still get reflected by the markets, and you're seeing the after effect in terms of how Asian markets are responding at this juncture. Obviously, a slew of data points are expected to come through. Specifically today, you're expecting the Japanese inflationary data. You're expecting our GDP print to probably come through, and late in the night, there will be the personal consumption expenditure data that will come through as far as the US markets are concerned. However, I think with the rhetoric that Trump is probably playing at this juncture, I think the markets are coming to a juncture where they are of the belief that either this has to happen.
Yeah. Okay, I think there is some kind of a disruption in what Mayuresh was saying, but clearly, as he pointed out, that he's still cautious on the market at this point in time. So one has to really wait it out to see how things pan out. Mayuresh is back with us. Yes, Mayuresh.
No, so I think to cut the point short, I think what really transpires in the next few weeks is going to be very, very critical for the market, because if the position probably goes on, as Trump has been rhetorically saying, I think that has an impact in terms of not just how the economies globally will probably fare, but what even happens to the US economy, because I think the prices will go up, inflation will still remain very, very sticky, interest rate cycle will probably get delayed and deferred by a huge time lag, bond yields will probably start moving higher, and because of that, I think emerging markets as well as currencies will probably feel the brunt to a large extent. So again, I think what really transpires over the next few weeks is going to be extremely critical for it.
Fair point. Well, the markets have started to take in the pre-open. It's a volatile start, 22,528 right now. It was in the green, but it has switched to the red. And now it's risking that 22,500 breaching on the lower side as well. Let's hope that that does not happen, but we'll have to see how that pans out. But Mayuresh, like you pointed out right at the beginning, that you're still cautious on the market. I wanted to just get a sense. There is this entire talk about that maybe we are entering the last end or the fag end of the market pain or the bearish trap. There could be a bottoming out soon. Where exactly do you feel, we could bottom out? We are definitely in an oversold market, but does that give us a sense that, we could bottom out soon? Because we have remained in an oversold market, overbought market for a long period of time. So, to say that, we are oversold, how long will that continue to be is something that probably you could help us understand better.
So anybody's guess, Sakshi. I think that's $1 million question, right? I think, and everybody knows that the market is oversold. There is no two ways about it. The only facet that the markets will probably watch also is the earnings, and earnings have remained soft. There is no two ways about it. A large part of the expectation is that even Q4 numbers will largely remain soft. However, I think with the boom and expectations in terms of the boost that it might give to the GDP in Q4, the tax cuts which have come through, which will give a boost in the first quarter and the first half of the next financial year, I think that is providing some element of relief and respite as far as corporate earnings bottoming out is concerned. And therefore, a large part of the market expectation is that in the first half of the next financial year, corporate earnings should largely bottom out. And if you see positive traction with the tax cuts that is happening in consumption, and if investments to private capex starts cutting back, the second half earnings should hold up as well. And therefore, I think that's the base case scenario that India Inc. is probably working out with. However, I think from a Q4 perspective and how earnings have played out largely for Q3, the expectation of the market is not that great as far as earnings are concerned. And therefore, I think how domestic earnings probably fare, how global cues probably are on offer as far as geopolitics is concerned, from tariffs is concerned, inflation is concerned, bond yields are concerned, is all going to play its part. And therefore, I think you have to have a very stock-specific approach in this market. You should not be very, very aggressive. I think that's the stand we've been carrying for the last few weeks. I think it's absolutely okay that if you watch the market from the sidelines, wait for stocks or sectors that come into your zone and where valuations and base structures as we see the market in India become a little bit more attractive, and then probably take a call onto the markets. But again, I think this year is going to be a sector stock pickers market, and you have to moderate your return expectations from the last 3 years that will be carrying you.
Absolutely. Moderating expectations is something that everybody has got to understand. But looking at all the factors that you pointed out, both globally and domestically, as what would be key triggers that the market will be reacting to, I wanted to get a sense, do you have some kind of an expectation as to which trigger could the market really bank on for a trend reversal of sorts, or could it be again a combination of factors? Because so far we've not got everything working in tandem. Everything has been either neutral or negative. But what could it be that could probably the market latch onto for a trend reversal?
So two aspects, actually. I think one, I think we've been harping about Trump tariffs, right? He's been UK Prime Minister at the White House, and he's clearly put out a statement that he's trying to work out a trade deal with them. So I'm of the opinion, and this is very personal in my view, that he will negotiate hard with either the EU bloc, with UK separately, with India, with other countries as well, because he probably knows that if it's going to be very, very aggressive, I think everybody's going to take a hit, and that's not good for global economy, and that's not good for America as well, because they're already sitting on a huge pile of debt. Obviously, he's doing measures through the Dodge measures that Elon Musk is doing. So that is one trigger to watch out for, that if he comes down on the negotiating table and then negotiates, which is something which is at par with what the markets probably believe and where the economists probably also believe, can be one good trigger point. The other point is, again, the dollar-yen trade that we speak about. It's a given consensus that the Japanese central bank might raise its interest rate by 25 more pips in the next 2 or 3 months. I think if there is a clear unwinding that probably happens, and in a calibrated manner of the yen carry trade, the upheaval that will happen in emerging markets and NASDAQ, which probably get impacted the most because of the yen carry trade, I think that triggers or that fallout might probably get out of the window as well, providing a respite, along with the base case scenario that I just pointed out for earnings moving in. So I think the next few weeks might be a little bit tough and volatile for the markets, but my own sense is that once we are through this price correction phase in the next few weeks and we go through a time correction, I think the markets will come out as we head into the first quarter or the first half of the next financial.
Fair point. Okay. How about the FIIs? How are you reading the trend there? The sell-off continues. As of yesterday, the quantum was pretty low. But are there any signs of FIIs returning, or is that still going to be far-fetched dream?
So I think two aspects. Again, Sakshi, I think if you look at the US bond yield, right, it's at 4.5, 4.6. So I think the equity risk premium for emerging markets, including India, I think that gap has narrowed. So I think that's safer in safe haven assets denominated by dollars, where the comfort probably lies. The second aspect, again, is that the entire FPI community was banking on India in terms of the growth dynamics that India was providing compared to the rest of the world. So even if you take the first half of last financial year, you look at the growth numbers, GDP numbers, you look at corporate earnings growth, was far, far superior than any market in the world, which is clearly risky. Now, once the growth starts coming back and they see those initial signs, which I'm again saying, which will be very, very evident as we hit the first quarter in the first half of the next financial year, and we see these imminent signs of growth coming back very, very strongly for the Indian markets. I think there is no choice but for them coming back, because outside the US, I think the next best place market I've always believed is India on all counts, whether it's earnings, whether it's political stability, and whether there is economic reforms and regulatory aspects as well.
Okay. Markets have settled in the pre-open trade, and we are actually looking at the Nifty probably opening at 0.5% lower at 22,433. So again, what we are looking at is 22,500 being at risk. More so, the Nifty Bank, which was bucking the trend as of yesterday, also seems to be indicating a negative start of about 0.6% lower, 300 points of a cut there. That was a big respite yesterday, but remains to be seen whether it continues with its momentum. Mayuresh, if you have to really look at it through levels, how much more downside do you believe could this sell-off in the market be till? I mean, could we go down till 21,000? Could 20,000 also not be ruled out? What exactly are you penciling in?
So very difficult to say. So I think what we've also said is that if you look at a lot of the data points that we have been mapping, right, including the dollar index, and there has been a lot of volatility there as well. So the dollar index below the 21 and 50-day moving average, you're largely assuming that what you've probably seen in the past, whether it's the COVID fall, the 2014 fall, 2022 fall, we are largely expected to see when such events happen the next few weeks or the next couple of months, the bottom out process happens for the Indian markets. One more data point that we probably mapped is only 15% of the stocks in Nifty 500 universe are trading above the 200-day moving average. Even lesser, if I believe. I think it's only 13% as I speak right now, and with the fall today might be even lower. So that's the least number we've probably seen in earlier falls as well. And therefore, that's a good indication that once this happens the next few weeks, the next couple of months, there is a bottom-out process that happens for the market. And in our own context at MarketSmith India, we follow the distribution in the account. Obviously, the markets are making lower lows. If they hit a low, and if that low is not breached for 3 consecutive days, you see a rally attempt and then a follow-through day, which is a 1.5% move on the Nifty, we can then say that for that cycle, the Nifty has probably made a bottom. Have we reached there yet? Probably not. What is the ideal level that the markets might bottom out? Anybody's guess, actually. But I think going by data points, but what we've seen, I think the next few weeks, I think we should have a bottom in place. Whether it's 21,500, whether it's 22,000, 21,000, very difficult.
Very difficult to say, but it could be in the next few weeks, hopefully so, and so some more weeks of pain, and then we could actually be looking at some positives. Let's also talk about the top regulatory change there, Mayuresh. Mr. Tuhin Kanta Pandey now heading the SEBI starting 1st of March. What's the sense that, you get the markets will derive from this change? Of course, we do know how Ms. Madhavi Puribhut's, at least latter half of her tenure was largely, ruled by a lot of controversies, regulatory changes that happened, many of them for the better and for making the markets a more safer place and, more reliable place for investors. But controversies also came in. Now that this change is happening, what exactly do you sense are the markets going to take as indication?
No. I think the markets will take as positive. I mean, I was hearing your opening remarks. I think he comes out with a solid brand pedigree. He's done fabulous work in the past, in the previous role as well. And therefore, I think the role of SEBI as a watchdog, as a regulator, they've done a fabulous job. And I believe that the same will continue. Again, I think from a regulatory perspective, Sakshi, I think whether it's SEBI, whether it's RBI, I think we have the best institutions globally as we speak.
Absolutely. Let's look at a few pockets then. Where can investors really look in this current trend to put in their fresh funds if they are having a lot of fresh funds coming in? Because I think there is this very peculiar situation that retail investors are finding themselves in. When the markets were on a one-way upward rally, they kept on pumping any money, any penny that they had. And now they are actually stuck in a situation where they are not getting a direction in the markets. They're scared to put in fresh money, or are they at a lack of putting in fresh money as well? Everything is stuck in a logjam situation in the stock markets right there. What are you advising investors at this point in time? Are you already seeing some signs of where exactly can the fresh money go to?
No, so actually, I think the first thing is that if you are a genuine long-term investor, continue your SIPs, right? Because that's the best way to probably reduce your impact cost. The second aspect is obviously, I think these times are the best times to probably dwell deep into certain sectors because normally you don't get time in a very evolving and a momentum-led market. And therefore, I think domestic-based sectors is where our studies are going on full throttle as we speak. So whether that's agrochemicals, whether they are hospital stocks, whether they are select infra companies, whether there are select financial companies. I think we are doing a really deep dive in terms of getting into the finer details. And our belief is that this year, domestic cyclical driven companies will do really, really well. You have to have the right company in place if you want to generate alpha in the markets, and that's where our best is.
Domestic cyclicals, and Mayuresh is clearly betting big on them at this point in time. Let's actually discuss a few more pockets. I wanted to first start off with banks and financials. Why? Because there was, of course, a kickstart yesterday. There was this RBI relaxed move that came in as a big sigh of relief for some of the second-rung private sector banks, NBFCs that have a large MFI exposure. This was a clear pain point over the last 3 to 4 months for most of these players. That started to, give them some relief. How are you looking at the banking financial names at this point in time? And what's your pecking order when you select? I mean, like Bajaj Finance was at an all-time high yesterday. Should one continue to ride on that winning horse at this point in time after a long haul that started to come in? Should one stick with the large private sector banks or a combination of all of this? How are you looking at it?
I think it's actually a mix, and for paucity of time, I'll pick it very quick. I think a few of the banking names where I think the core parameters are top-notch, where earnings is expected to hold up, and where the balance sheet strength is very, very evident from every preceding quarter numbers. I think that is where I think the strength probably lies. For NBFCs, I think yesterday's news, I didn't understand why they reacted so positively. But again, I think in a phase of the market, I think you need to concentrate specifically in phases like these on leadership stocks, because leadership stocks within the NBFC universe have three distinct advantages. One, I think because of their corporate pedigree, the capital adequacy is extremely strong. Their credit underwriting skills remain top-notch in market conditions like these. And third, because of their better pedigree that they probably got, the credit ratings that they probably have, their cost of borrowing is far, far superior considering the rest of the pack, which gives them the advantage of superior NIMs and therefore better balance sheet growth.
Mayuresh, a painful start of the March series. Historically, I don't think March has actually given a clear direction. At least in the last 4 or 5 years, it's been mixed in terms of the performance in the series, and we're coming with a heavy, load of 5 months of pain. What's the sense that you're getting?
I think, again, Sakshi, I think if you look at the broader markets, right, I think a large part of the pain now, in my belief, in the price, because you've seen certain stocks correct 50, 60, 70 odd % from their all-time highs or 52-week highs, however you want to put it. So I think a large part of the pain is now getting gestated as far as the broader markets are concerned. The second element, again, is in terms of the de-rating that is probably happening. Because if earnings are expected to come off, you cannot have sustained valuations happening for sectors where the overall macro picture in terms of GDP numbers expected to come off, and therefore micro numbers might also start coming off. So the de-rating that you're probably seeing has largely happened for a broad pool of markets. For certain sectors, it might be a little bit more evident as we head into Q4. But as we end Q4, again, I think that's my belief that a large part of the earnings pain will also be behind us. And therefore, one must comprehend and understand that the markets will go through its periodicity of cyclicality, which it is going through in the last 6 months. Yet this has been extremely frustrating. But again, I think the last 2.5 years have been exceptionally good for the markets. We had been clear outperformers. Our valuations were clearly ahead of our peers as well. And therefore, I think the de-rating is something which is in line with what the earnings are probably throwing up. But as they show signs of improvement, which is again what I'm trying to say time and again, you will see some element of respite coming back. Markets assuming certain base factors as we head into the first half of the next financial year. And as things improve from there, my own sense is that with FIIs and PIs expected to return, there will be some element of re-rating that markets will come through as well. So yes, you'll have to go through this periodicity of pain that we are going through, but it's part and parcel of the markets that we've probably seen in the past as well.
Mayuresh, any safe havens in this kind of a painful market?
So Sakshi, I think, frankly, if I tell you, I think investors need to also be aware of the risk management processes and practices, right?
Yeah.
Because that is where the Indian investor is probably lacking. You can't marry a stock. It's as simple as that. I think if there is some element of pain that a sector is going through, and if there is clear de-rating that is happening, even if you're at a loss, I think it's better get. I'll give you a very simple example that we always carry in our tutorial markets with India, right? A large part of the broad market pool is down 50%. Now, if you have held on to these stocks need to make a full 100% reversal just to get to your break-even. So that is how difficult these markets are going to.
So what is the best way out? You tell us, expand that a little bit. All those viewers of ours, they keep on asking us these days on our daily calls show, which is a caller show that comes in at 12 p.m. Every day I get a lot of calls saying that, okay, I'm stuck at this position at a higher level. Do I average right now or should I wait? So everybody is wanting to average down their positions. Is that the right approach? Maybe be it for railway stocks, for defense stocks, or for PSU stocks where the maximum pain is. Do you think averaging out strategy will work, or do you think one really needs to take, bite the bullet, like you're saying at this point in time, and maybe revise the strategies that will work better in this kind of a setup?
So again, Sakshi, I think being very earnest and honest about this, right? If you are holding on to some positions where you're seeing the estimates for that sector not expected to do well, don't expect magical returns happening for that sector itself. Second, I think if certain stocks within those sectors have been at an overpriced situation, overvalued, late stage basis as we see, and they're correcting, but the fundamentals still stick around with that stock, right? It then makes patience. It makes sense for you to have patience in terms of holding. Now, whether it takes a few months, a few quarters, I think it really depends on market conditions. But if both these conditions put together are not working in favor, that if the sector is expected to underperform and two, the stocks within those sectors are clearly lagging for some reason or the other in terms of its financial performance or otherwise, it's better to bite the bullet, I think. And therefore, I think having a very strict rule-based approach in the market always works wonders in terms of your long-term returns.
Fair point. Viewers, you'll notice that we are not incrementally talking about stocks at this point in time. Just like how Mayuresh and Mitesh both pointed out, it's going to be extremely important with your strategies. We are just going to be giving you a broader sense of how your strategies should shift in this market as well. Many thanks, Mayuresh, for being with us in the morning edition, helping us sift through all the triggers globally, locally, the trends that may shape up. Of course, few more weeks of pain, and one really needs to solidify their position in case one has a long-term vision to get the better side of the market once the pain also reverses. Thank you so much. Always a pleasure to speak to you, Mayuresh.
Thank you, Sakshi. Just a final point to all the investors and viewers who are listening, right? Be calm, have patience. I think have trust and faith, right? You've seen good phases of the markets. There will be bear phases and bad phases in the market as well, and this is part of the market cycle. So don't get overwhelmed in what the market is probably throwing at you right now. Have faith, have patience. India still remains the best story of the next 10 years.
And that's the perfect way to end the conversation with you, Mayuresh. We will continue to remember those words, and I hope all the viewers also have that long-term way. Thank you so much, Mayuresh, for being with us.